we do think there's a bounce coming today, maybe day one of the bounce, and it may be only 3 or 4 days, but it may very much be that we get back up to near 6,000 on the S&P 500.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week. It's a good week because instead of Lance Roberts, this week we have the unflappable portfolio manager, Michael Lebowitz. How are you, Michael?
I'm doing great. Thank you.
Yeah. All right. Well, look, I used unflappable for two reasons. One, because you are a very even-keeled guy. You bring a lot of calmness even when the markets are as volatile as they've been the past couple of weeks. I thought it was a good week for an unflappable host here because I think a lot of folks are feeling the sting of the past couple of days in the markets. So we'll get into just a second, folks, about what the markets have been up to. If you are watching this video when it launches, the morning it launches, Saturday morning, in real time, I will actually be running Thoughtful Money's spring online conference. And if you're watching this, probably means you chose not to join the conference. But if you decide you still want to jump in, you still can. You can do that by going and buying your ticket at thoughtfulmoney.com/conference, and then you'll get sent directly into the live event. If you're watching this afterwards and are saying, shoot, I really wish I'd caught that event, don't worry. All the replay videos from the event should be available starting the day after this video goes live, so Sunday. And if you want to buy the replays, all the presentations, all the live Q&As, you can do so at that same URL, thoughtfulmoney.com/conference. All right, Michael, look, with that out of the way, basically the question I have for you this week is, what the heck just happened? we saw a lot of market cap vaporize, right? Trillions and trillions of market cap vaporize. The day we're talking, Friday, the market looks like it's bouncing, and everyone's been asking, when is the tradable bottom in? So what the heck just happened, and is a tradable bottom in?
So, not sure if it's a tradable bottom. A tradable bottom, yes. I'm not sure if it's a bottom. What I would one thing Lance and I came on our own conclusions, but late last year to the same conclusion that 2025 was likely to be a roller coaster, up and down, but a roller coaster always starts and ends at the same point. So you get these nauseating drops and these thrilling rises, and you basically go nowhere. And so far, we're down a little. We're down, what is it, 10% or 10% from the highs?
Yeah, as of yesterday, we were in correction territory.
Yeah. Today we're up 2% or whatever it is as of, Friday midday or so. But the point is that we are in a very uncertain political environment, not economic environment yet. Now, obviously, politics play a big role in the economy, but we have a president that is every 5 minutes coming up with a new tariff, taking away a tariff, saying something different. I don't care about the stock market anymore. I want to get bond yields lower. And I think it's really tough for a market that likes certainty. They want to know what's happening. Companies want to know if they can spend money. And because of the uncertainty, you create anxiety, angst among investors. Corporations are a little tied up. They're a little handcuffed because they don't, some of them don't know what to do because they're waiting to see how all of this plays out. So I think what the markets have kind of morphed into over the last 6 weeks, 4 weeks, whatever it's been, is what I would call a risk on, risk off market on an asset class level. So risk on, that means buy. So high beta, growth, crypto. Those are the things that that do the best in the risk on market. Risk off, buy bonds, sell those high beta names. They got hit the worst. And accordingly, because it's kind of this bipolar risk on, risk off, binary, not bipolar, binary type market, assets are getting bought and sold whether it's risk on or risk off. So when was CPI? Wednesday, Tuesday, whenever it was, A client said, "Why are bonds trading off?" That was a good CPI number. And it was. It was lower than expectations because at the time it was a risk on kind of day. And bonds are in the risk off category. And we've just seen that where you have to kind of, if you want to understand a market, forget about fundamentals for the next 10 minutes and just focus on what's in vogue, what's not in vogue. And they're just moving in opposite directions. And doesn't necessarily make sense, but that's what's going on. And you just have to, this is why technicals are so important to us because it helps us keep a more level head as opposed to falling for the emotions and the gut instincts to trade the market. We let the technicals just guide you, and it's not blind, but you have enough gauges that it's like an airplane pilot flying through a cloud. They don't know where they are, but they trust their instrument panel. And in markets like this, we have to rely a lot more heavily on that instrument panel than we may otherwise.
Okay. So, Michael, I may ask you then in a minute or two, or whenever you want, to pull up the latest chart of the S&P just so we can see what the technicals are telling us in terms of overbought, oversold, daily moving averages, stuff like
Mhm.
that. As you're maybe doing that, let me ask you this question. So, if I kind of got the gist of what you were saying, it's less that the market's drop recently is because the market is looking at economic data and saying, oh, something's changing, therefore I'm having to reprice. Um, it's more that the market is saying, okay, we just got like three different extreme policy decisions made over the past 2 hours, and we're getting whipsawed around, and we're feeling uncertain, and therefore we're discounting because of that. The reason why I'm making this distinction is Lance has been talking a lot since the beginning of the year. He and I have been talking about it since the beginning of the year about the extreme levels, extreme valuation levels in the markets, and that they're not a great timing mechanism, but over enough time they do mean revert. And one of the things Lance has been specifically looking at is projected earnings over the next 12 months, and saying, look, there's just no way companies are going to hit these. And at some point, stocks are going to, analysts are going to have to admit that fact, and stocks are going to have to reprice for that. So it sounds like what you're saying is that repricing based upon overly, ambitious earnings, that may not be what's driving this yet. It's more on the policy side, meaning, hey, if we get some relief on the policy side and things quiet down, there still may be more shoes to drop on the economic side, on the earnings side later on this year.
Yeah, and look, I'm not saying this is just all about what comes out of Trump's mouth. It's not. The economy is certainly showing some signs that it's starting to slow. But it's not showing signs that we're in a recession yet. But we have seen some data. The unemployment data was fine. The headline data was fine, but the U6, which is a much more inclusive unemployment rate, rose 0.5%. The household survey lost, I forgot the number, something like 300,000 jobs, 350,000 jobs. Retail sales was abysmal a month ago. CPI was weaker. PPI was weaker. Some of the survey data has been weaker. Today, University of Michigan sentiment fell sharply. So there are signs that the economy is weakening. And look, we've talked about this. It's getting long, and the recovery has been long in the tooth, and it was largely driven by stimulus government spending. That's coming to an end. Forget what Trump's trying to do. The stimulus from years past is pretty much out of the system at this point, and now you have a president that wants to cut fiscal spending. So that's going to weigh on the economy. So you have to kind of factor that in as well, which will weigh on corporate earnings directly, although we have yet to see earnings expectations really decline. They've declined very slightly, but not much.
Okay. So maybe there's a little bit of dual going on, but still, if I'm getting you correct, it's more the uncertainty of kind of what's happening at the political, geopolitical side of things, more so than people getting super concerned about the or the existing economic data, even though some of it is starting to weaken here. The reason why I'm just
Yeah.
trying to kind of parse this is if we continue, there's arguments to be made that the economy could slow substantially further from here, and so there may be more reasons for the market to get increasingly concerned about the economy. Just because you mentioned it, I'm gonna maybe this might be the last time we use the analogy, but you're essentially saying that the stimulus pig from COVID is now pretty much fully through the python. Lance and I talked about how it actually was like they had shoved a big pig into the python during COVID. But as the pig was traveling through the snake, they still kept feeding the snake pork chops. And that was sort of the ongoing level of deficit spending that we've been doing. Now, with the new administration, not only are they not feeding the snake anymore, but they're planning to put it on Ozempic, right, with Doge and all that type of stuff, right? So, we're probably going to end up with a lot skinnier snake at the end of this year than we've had for the
Right.
past couple of years.
Right. And we'll see what he can do. It's really hard to cut spending. And you're starting to see that in the initial data coming out that spending hasn't been cut, despite what we hear in the newspapers and the media. So we'll see how much spending is actually cut. But any spending has been government spending has been propping up the economy. So any spending, even if it's less than what it was, is takes away from growth. So I think that analogy is right. But the big pig is pretty much exited the system. Those pork chops are working their way through, but they're nothing compared to the 2020, 21 pig that was put, the two
Gone
pigs
through.
that were pushed through the system.
Yeah, yeah. All right. Well, look, let's if we can, let's pull up the S&P chart here then, and let's actually, as we're flying through this uncertain time where we don't have a lot of range of vision, what are instruments telling us right now?
Okay. So we have a few things going on here. This is the S&P 500. It's broken all critical support, the 200-day, 100, 150, and the 50. Or I'm sorry, the 20 to 50 and the 200. Um, let me shrink this a little just so we can get a better view. And you can see it's really the first time it's broke the 200 since going back to Halloween of 2023. Now, what's important here is it did break it. And, while these moving averages and other trend lines are very important, they're not perfect. And quite often it will go through, the price will go through a trend line or through a moving average and then revert back above it or below it, whichever the case may be. So here you can see we've dropped below it for the last 5 or 6 days. That's concerning. But now what we want to see is on the bullish side, we want to see it get back above the 200, maybe retest the 200, go back down to it, and then pop higher. What we don't want to see is it go up to the 200-day moving average and bounce off it and go lower. So that's one thing we're closely watching. And then you can see the 20 and 50-day moving averages up here are another point of resistance. So those are the first kind of two hurdles that the market has to make. First one being the 200, get above it. Second one, the 20 and the 50-day moving average. And then the last hurdle will be the prior high. We think it's likely one of those three that will be the end of this bounce, and we could resume lower. So further evidence, though, that we are in for a bounce is the MACD, moving average convergence divergence. And two things to note here. One is just how low it's gotten. That's much lower than prior lows. You can see it this low in 24, this low in 24, 23. It's gone well below that. But it's starting to look like it's getting ready to turn up. And I have another graph for you a little bit later that may be a leading indicator of this to help us. But when the blue line can get back above the signal, which is the red line, that denotes that it's a bullish flip in the MACD. We're not there yet. The RSI on the very bottom is turning up. It usually turns up first. It's usually an initial indicator. But, like you can see back October 23, it turned up, went back down. It's not necessarily it doesn't trend as well as the MACD. So it could just bounce along the bottom as well. It's just very oversold. And Lance's new favorite, the money flows. And you could see they're negative for the first time in a little while since the beginning of the year, but they're not deeply negative. So it tells you there has been decent support despite the sell-off. So you can read this two ways as well. Either that support's going away and that money flow indicator is going to get much worse as all those people buying are just getting tired of getting run over and will sell, or that the market's still in a bullish trend and will continue higher.
Okay,
So
go ahead.
no, so we do think there's a bounce coming today, maybe day one of the bounce, and it may be only 3 or 4 days, but it may very much be that we get back up to near 6,000 on the S&P 500, or that we challenge the 20-day moving average, which is just a hair under 6,000 or around 6,000. So that's, kind of what we're looking at now. We've done some trades to rebalance back into some of those higher growth tech, high beta names, anticipating a rally. Again, we don't know if this bounce is a 4 or 5 day bounce or a 2 month bounce or even longer or a resumption of the bullish trend. And again, while we may have our opinions and our gut is telling us something, the technicals are, these and many others that we look at are guiding us and kind of telling us how to trade the market.
Okay, so right now the technicals are telling you, hey, it looks like we'll say the rubber band has gotten stretched probably to its maximum here. You're seeing some initial indications on both the MACD and the RSI that it may be starting to slightly snap back here. So my guess is you would say that your base case here for the next couple of days, weeks, is back to your and Lance's original thesis for the year, which is it's going to kind of be, a volatile roller coaster where it's going to be, ups and downs, ups and downs. We may be completing it down right now. We'll go back up, probably,
Mhm.
punch through the 200-day moving average. And Lance has been saying, so I want to see if you would corroborate this, that we are probably in an environment that's a sell the rip environment, which is,
Mhm.
once you go through these downturns and you get that bounce, rather than adding back in and trying to see how high the bounce goes, it's more, hey, if this thing gets high enough, let's start lightening up on some of our positions that we were feeling a little nervous about when the drop was happening.
I think that's fair. Um, Obviously, when we get up there, when we start climbing that next hill, we'll see what the technicals look like. We'll see what's going on politically, geopolitically. And the other thing I didn't mention, which is very important, is that sentiment. Things like the fear greed indicator and so many the AAII surveys, they are so washed out. Sentiment is so bearish that it's at levels you typically see at significant market bottoms. And that's, that's unusual to see it after 5-10% drop. So that again argues for the rubber band theory that's just stretched too far. Doesn't mean it can't stretch a lot further over time, but for the moment we've stretched it too far and it's got to come back a little.
Yeah, and let me share this chart too that Lance actually shared on his X account the other day. It is a chart of retail purchases of U.S. stocks and ETF by day, and basically showing that as the market has been declining here, that people have actually been buying more. And so this isn't a sign, even despite the sentiment that you talked about, it's not a sign that people are capitulating and giving up, and are frightened and getting out of the market. It's that they're coming in saying, is this the bottom? Is this the bottom? Is this the bottom? There's still speculation here of like, I still want to play this thing like a casino. So in Lance's, words here, he says, look, we're not going to get into a bigger corrective cycle when retail investors have FOMO over missing the dip. So again, we'll see what happens, but if people were selling into this, that might be a sign that, hey, this thing has further to go because people are getting out of the market, where it does seem that there's still some optimism, there's still some speculative hunger here.
But tops are a process. Forget 2020. That was a black swan, something no one could predict. It just happened almost immediately. The economy just shut down. The global economy shut down. We've never seen anything like that. Tops typically, that's not how tops work. They're processes. It looks kind of like a mountain range where you're setting higher highs and higher highs, and the economy, everything's going well, and then all of a sudden you drop and you set a high, you bounce and you set a high, but it's not as high as the last one. Now you're setting lower lows and lower highs, and there's a rounding process to that, which helps you understand what's going on. That's why what happens next? If we go back to new highs, we're still back in that bullish trend,
Right.
going back from the recovery in 2020. If we go back and we set a lower high, and then a lower low below where we were yesterday, assuming today's the bounce, who knows? But that's a sign that, we have to start being a lot more careful that we may be in a downward trend and our roller coaster may end below where we start. Um, so if you want, I created a little PowerPoint this morning with just a few of my the things that we're looking at to
Perfect.
help better assess the market. If you want me to share that?
Yeah, no, absolutely great segue. And whether it's while you're going through it or after you're going through it, just one big question is are you guys at RIA, are you adding here? Like, hey, we think this is more likely than not a tradable bounce, and therefore, we're trying to add back in at some lower valuations here, or are you just sitting on the sidelines waiting and seeing?
So over the last 2, 3 weeks, we've rebalanced. So what that means is, let's just say you know, Apple is a 5% position in our portfolio, and we have 25 or so stocks and bonds, and everything's moving. If Apple's underperforming, all of a sudden it could be only 4.5% of the portfolio. And something that's doing well, Johnson and Johnson, that was also five, could be 5.5. So when we rebalance, what we're doing is buying Apple back up to that 5% model weight and potentially selling Johnson and Johnson down to the 5% model weight. So we're taking profits on J&J and we're adding a little bit to Apple. We've been doing that. We took profits on some of the drug companies we own, uh, JP Morgan, Walmart, a few of the safe, more conservative companies. And then over the last week, we've been buying the beaten down stocks, Google, Microsoft, Nvidia. We actually added 1% to ANET. I'm sure I'm missing a couple, but we basically a few weeks ago, a month ago, we took profits in some of the more conservative names that were just getting too far ahead of themselves. And then over the last week or two, we've been adding to the names that have been beaten up. Not our exposure hasn't really changed all that much, but we're rotating with the market.
Okay. And
So
this is sort of what Lance talks about, when he talks about his principles of gardening in the portfolio. And really what you're ensuring you're doing here is you're selling high and buying low here.
trying. That's the
Yeah.
name of the game.
Yeah.
So, and actually, the graphs and charts I'm going to show you kind of give you a little bit of insider baseball here, kind of some of the tools that we use to do this. So I put together about 4 or 5 charts that are kind of some of the things we've been watching to help guide us to basically calm our nerves down, to help us appreciate what's going on in the market. And the first one is probably one of the most simple tables. Just also keep in mind, all of this is from SimpleVisor except one chart. And when we get to that chart, I'll tell you which one it is, but everything else is from our SimpleVisor website. So this market summary is on the homepage, and it's a very simple way to see what's going on in a market at a very high level. You could see at the top, you could see what's going on for the day, the week, the month, quarter, out 2 years. And all we do is separate out large, mid, and small cap, so size of stocks, versus whether they're value, kind of in between, value and growth, or just growth. And the one thing that has stood out like a sore thumb is the circle I made. It's the large value, large cap value stocks. These are year-to-date returns. Large cap value is only down 2%. Large cap growth is down almost 8%. And you can see as you get to the smaller cap growth, even mid cap growth, down 9, 10%. So value, large cap value has outperformed everything by a long stretch. We've seen that, the names like JP Morgan, Exxon, those Berkshires, those more value oriented, non-tech, not high beta stocks are just have helped up, have they've buffeted our portfolio significantly. There were some of those big down days where half our portfolios were up. And in large part, it was those large cap value stocks. So with that, we have a rotation tool in SimpleVisor that we look at every day. And it works on both sectors, the 11 S&P 500 sectors and factors. So factors such as value, growth, large cap, small cap, and I think we have 21 or 25 factors that we can kind of categorize stocks into. And what I have here is, and what we do with these is we create scores, technical scores. We apply 14 different technical indicators and analyses to them. And from that, we get a score, one being the highest, -1 being the lowest. And they range between that. And when it's close to 1, it's very overbought. Close to -1, it's very oversold. And what we tend to find over time is that those stocks that are very overbought tend to underperform, and those very oversold tend to outperform. Now we do two calculations. One is just on the price itself. That's called absolute. So we apply these technical indicators to the price of, let's just say, consumer staples. And it spits out a number and it tells us just whether the stock is overbought or oversold. The other one we do, which is very important, is the relative analysis. So instead of using the price of staples, we use the price ratio of staples. So what's the price of the staples ETF divided by the S&P 500? And we use that price ratio. We apply all those technicals to the price ratio, and we get a relative score. So the market could be plummeting, but if staples are beating the market, it could be relatively overbought, while its absolute score could be very oversold. So, kind of keep that in the back of your head. Now, you can list them, sort them. You can look at the underlying stocks within the indices to see how they're doing. But we also have this graphing tool where you can graph all of them or some of them. So what I did was segregated out IVE, which is large cap value, and IVW, large cap growth. And what this does is it tracks the daily relative and absolute scores over the last, I picked 5 weeks. And those little red arrows at the end of the blue and the red lines show you where they're at today. And you follow the lines back to the beginning, you can see where they started. So let's just look at the blue line. You can see that the absolute score improved, kind of stayed the same, and it's deteriorated. So as the market's been selling off, its absolute score was kind of staying the same, meaning that large cap value was hanging in there despite the market selling off. But recently, they've been selling off too, and you've seen a deterioration in the absolute score. But the relative score over the period has improved until very recently. So it's been outperforming the market. Conversely, growth started in the upper right quadrant, meaning that it was overbought on both a relative and an absolute basis. Now it's oversold on both a relative and absolute basis. So it's a way that we can kind of chart and see what's really going on, because sometimes it's not as, the table I started with and other things don't really tell you the full story. This shows you how they've been basically rotating in opposite directions. Very helpful.
Yeah, and so a trader here might look at that and say, growth may have the beatings in growth may have played out here because it doesn't have too much more to fall, and its most recent data showed that it was actually rising on the relative uh, score, whereas IVE value, you might say, hey, that's the good days have played out, and maybe now the market's getting ready to rotate back into growth.
So what is a rotation? Rotating is a circular move, right? So, and these do not rotate in perfect circles. But if the trends continue, you could see that the red line's going to come back up and around, and in clockwise fashion, and the blue line is in counterclockwise fashion, heading down and to the left, right?
Yeah.
Uh, doesn't happen nearly as nicely as even this graph shows. There's nothing stopping IVE from going back up and to the right and IVW going down
Right. It's
or
just a
backtracking.
snapshot,
It's a
but
snapshot, but they do tend to rotate,
yeah.
in somewhat choppy fashion. The next one's going to really, I think, blow your mind. So what we've done here is, remember we talked about the relative analysis. We
Mhm.
take the price ratio. What's IVE, the price of IVE divided by SPY? And that gives you basically just the excess return. So what I've done here, and this is stock charts, this isn't from SimpleVisor, is graph the price ratio of IVE to the SPY, the S&P, and growth, IVW, to the S&P 500. And you can see that they're mirror images of each other, right? It's almost perfect. It's kind of
Hmm.
eerie. And what that's telling you is that on days when value outperforms the market, growth underperforms, and vice versa. It doesn't mean let's just say the market's up 1% one day, all this means is that growth was up 1.25% and value was up 0.75%. They can both be going up, but that relative return to the market is almost opposite on, almost any given day. Um, and we have within SimpleVisor, we have a tool that helps us spot what factors are like that was almost a perfect correlation, a negative correlation, right?
Yep.
But what other factors are doing that? Where else can we say, okay, if small caps are overvalued, what's going to be undervalued? Where can we expect a rotation? So I clipped this screen. It's actually a much bigger table, but I clipped it because what this shows is over the last 126 trading days, it shows the correlation between all these different factors. And I've in the yellowish blocked off areas, again, we're comparing value to growth. The intersection of those two yellow rectangles is the correlation. So over the last 126 days, the correlation of those excess returns, which is very similar to the graph we just showed, is minus 0.97. It's almost perfectly negatively correlated. If the market's going to be up, growth will be up more, value will be up less than the market, and vice versa. So we can use this table to help us find other things. So, if you look to the right, you could see MGK has a very negative minus 0.92 to IVE, which is value. So that's large cap. Those are, the largest names, mega cap. And you can, there's other ones that are in there as well. Um, so the point in showing you all these is that it's clear that the market has been favoring large cap value, selling large cap growth. So if we can understand how that is large cap value still in vogue and large cap growth still being sold? And if we start seeing signs of life in large cap growth, that may precede the market as a whole. So the next tool we have is let's just chart the price ratio of IVE to IVW, right? We're continuing on the same theme. And the blue line, and so there's four charts here, right? The blue line is that price ratio. And what you can see is that generally over the last, I guess, year and change, it's been trending lower, bumpy, but trending lower. And since about mid-February, it's been, it bounced up. Now, keep in mind, the price ratio went from about 1.85 to over 2. So that's, a 7, 8% change. That's the outperformance that we've seen that we showed in that very first table, that approximate 8% outperformance. So that's nice to see, but what we can then do with this line is apply technical analysis to it. And that's where we have these three charts here, and I've circled where they are currently. The first one is a proprietary oscillator that we use. It's very similar to the MACD, but it has different specifications. And again, like the MACD, we can see it's still in buy mode, so buy EVE, buy value, sell growth, but it's very high and getting ready to turn. The next one is the MACD, very high, getting ready to turn. And then the third one is a stochastic model, which has probably turned today. So they're all telling us the same story, that the value growth trade is getting long in the tooth, and value and growth may be ready. Investors may be starting to rotate into growth at this point. And then I'm going to end with Nvidia. What's the growth story? It's Nvidia. That's been kind of when you talk about high beta growth, that's been Nvidia. That's the market darling,
And
or
the
the
poster
market.
child. Yeah.
Yeah, I mean, stepchild recently, but it was the darling, the Cinderella. And let's just look at the graph of Nvidia, because I think Nvidia will lead the market. It led the market lower. It's probably going to lead it higher. And what we see here is that it looks like it's turned already. It's been much more resistant the last few days in the market. It's outperformed the market over the last few days. And on the top, we can see the MACD is, if it hasn't flipped, it flipped today onto a buy signal. And you can see the last three times it's flipped. Those green bars show you the last three times it's flipped from very low levels. You've had a decent run. The first run in what is that, May of 24 was huge, from 90 to call it 150-ish. That's a significant rise. The next two following the green bars were still nice, but not to the same degree. And it looks like we're about to trigger another green bar, so we could see more gains coming from Nvidia. On the bottom, you can see the RSI, unlike the S&P, which we showed, has shown a more definitive bounce. So, and the money flows, which is the greenish behind the price, haven't turned yet, but we suspect they will change too over the next couple days. But again, just like the S&P, you got some key moving averages dead ahead that we need to get through. So, I guess just the overlying point is that high beta growth is showing signs of life before the market is. And that's, maybe a sign that this market is getting ready to turn around.
Okay. So, early indicators seem to suggest that, yeah, maybe the beatings are ending here, and the market will have, some sort of material bounce going forward from here. So, it not enough that it sounds like you're buying, hand over fist, like, oh my God, we're going to new highs. You're doing more of the
Well, let's backtrack on that. We are more or less fully allocated. So no, we're not really doing backflips and buying more. But if I was an investor that liked, let's just say I'd like to have a portfolio that's 50-50 stocks, bonds, but I only had 20% stocks today, I would be buying here.
Okay. All
Maybe
right.
for a trade, It may be for a trade, but I would be
Yeah.
buying because I'm under allocated. We're not under alloc, we're slightly under allocated, but not meaningfully enough to matter. So there's no reason to press a trade like this.
Okay. Well, thanks. That's good clarification. But basically, you're kind of becoming short-term bullish on the market given these indicators. But it sounds like what would invalidate that would be, well, obviously continued weakness in the market, but or if it went up to the 200-day moving average and then fell again. In other words, if what was once deep support now becomes resistance, that would probably tell you there's a different game now in play, correct?
Yeah, yeah. I mean, it's not just the 200. It could be the 50, the 100, or the 20. And then we go back and set a lower low. That's not good. And or you know what, the market does okay for a few days, and then large cap value starts killing it again, and growth is getting hurt. Those are all, and there are a lot of other things we're looking at too, but those are the kinds of things that we're paying attention to. If Nvidia starts crapping out, if some of those other high tech names starts failing, crypto, that's another one, right? Crypto led this thing too. If crypto starts having trouble, even before stocks, that may be a sign. So, like like an airplane, there's a ton of gauges to look at, and it's not just one gauge. Like a car has one, you're right, this speedometer, right? There's
Yep.
pretty much it. Maybe RPM if you got a fancy car, but an airplane has. I don't know how to fly an airplane, but I've looked up there, and there's stuff all over the place. And Lance and I are looking at tons of gauges, and sometimes they all jibe, sometimes they don't. And it's, we have to, that's what we have to steer this plane with.
Okay. Well, notable on the day that we're talking here when the market is, having this bounce in the immediate term, Bitcoin's up nearly 5%. So it is showing that that speculative gauge is turning green. All right. So there, we've talked about, your best assessment of where things are like right now for the next, short term week or two, maybe where things are likely to go. You said that you and Lance think this year is going to be, a roller coaster year. Having talked to Lance enough, I think I feel comfortable, summarizing his view of, wouldn't surprise him to see this market end flat for the year, with a lot of volatility in it, but also wouldn't surprise him to see it end lower too. There's the issues around the aggressive earning estimates, or I think what Lance would say, unrealistic earnings estimates. And then there's just the whole macro environment, right? I mean, there's the whole, hey, the economic growth is slowing. Obviously we're all watching the GDP nowcast, it's just down in horrible numbers, but that's probably going to bounce around an awful lot. So take that with a big grain of salt. But, um, uh, discussions of, hey, there was a lot of unsustainable macro trends coming into the election. So no matter who won was going to have to contest with those. We're beginning to see those arrive in force. And again, that's one reason why economic growth is slowing. Inflation isn't slain, although it does seem to be getting more contained. But also, Doge and the fact that it may just, reduce even just the growth of spending, but maybe even could reduce some of that again. And there's the tariffs and all these things that people are now beginning to wake up, which we've already been talking about this long before the election, that these policies might be so disruptive that they could push a weak economy into recession. Now, Wall Street's beginning to ask this question, and they're asking the question directly now of Trump and his cabinet. And basically, they're saying, yeah, maybe. It's so different from Trump 1.0, where it was all about the stock market, and it was just everything I do is big and beautiful and perfect, and tomorrow's going to be a better day than today. Trump, Vance, both recently have been asked specifically about, could the economy go into recession? They're saying, well, anything's possible. And Trump when been asked directly about this, said, hey, look, I care a lot more about what I'm trying to engineer here, right? I'm much more focused on the change that I think is going to be great for the country and less so on what the stock market's going to do in any day. Now, some other of his lieutenants like Bessent have been even more direct, like, hey, we're going to go through a detox period, folks, Right, which is again the communication that Lance and I have said, hey, if we were advising the Trump campaign, we would be advising them to get this message out early in the campaign.
Right.
And not that they listen to this channel, but they actually seem to be doing that now. So where I'm going with all this, Michael, is just, yeah, maybe we can be kind of optimistic here for the next couple of weeks. We might get a good bounce. Um, but for the litany of things that I just mentioned, and I'm not asking you to make a long-term market call here, but you know, how concerned are you that these shoes may drop enough this year, that the economy slows enough, that the markets have to go through a substantial repricing from here lower to price in that slower growth?
It's definitely a concern. There's enough balls in the air that are troubling that it's a concern. Uh, on top of that, you have high valuations, high expectations. That's not a recipe for great
Right.
returns. So, we'll see what the year brings, but what if Trump does get some tax cuts through in the next couple months? What if they don't follow through on some of this fiscal spending cuts like they said? What if we get peace in Ukraine and Russia and better relationships with Canada and Mexico and some of these other tariff and China, right? Things can change. I'm not so sure. I think Besant and maybe Vance don't care about the stock market. I still think Trump's staring at it every day. And while he's probably cursing in private, he's putting on a face in public. But I think the stock market is very important to him. I think that, like it was the first term, it's still his barometer. Now, maybe he's wised up a little bit and said, maybe I'll just see what the barometer is at the end of 4 years
Mhm.
instead of hour by hour. But who knows what he's thinking. The one thing I want to, if you don't mind me touching on, is you talked about the GDP nowcast or now.
Mhm.
There's two types of forecast models that the Fed does. One is the Atlanta Fed GDP now, which is the one that's plummeting. I think it's down what they're expecting minus 2.8% growth. May have been revised recently, but something like that. And the other are these nowcast models. I believe St. Louis and New York Fed do nowcast. And there's a big difference between the two, and it's worth appreciating because if you just look at GDP now, it'll scare you to death. Um, it went from about plus 2 or 3% to minus 2% or so in a matter of like a week. Um, so maybe I'll use a football analogy for this. My Commanders are playing your 49ers, right? And after the first quarter, Commanders are up 10-0 and driving the ball. GDP now would say, oh, well, we have the quarter. Let's just annualize that quarter. And they'll say the final score will be 40-0. The nowcast, what they do is they factor in that data, but they also look at how that data compares to its longer term time series. So they'll say, yeah, the Commanders always jump out to a nice start, but the 49ers are more of a second half team. So based on everything we've seen, the score will be the Commanders will still win. Sorry, but it'll be 28-25 or something like that. So the problem with GDP now is on day one of a new quarter, it only uses data it has for that quarter.
Right.
So if you get a surprising data point, it'll shock GDP now. If you get a surprising data point at the very end of the quarter, it has a much less effect. So over time, GDP now actually is a better estimate, but that occurs over the course of a quarter. And again, data is delayed. So, we're just now looking at February data. So we're, not even halfway through the quarter, even though we have 2 weeks left in a quarter from a data
Mhm.
perspective. So GDP now will likely improve. Some of those nowcasts may come down. They really haven't budged all that much. They've come down a little. So just be careful when you're looking at GDP now.
Okay.
Uh, but understand it is a very good barometer, but much later in a quarter when there's more data.
There's more data. Yeah. All right. Well, look, good, very good qualification. So, uh, I want to get to bonds in just a sec, but just to put a bow on this, sort of reason why I asked you that question is you and Lance have to manage the difference between macro and TA, right? Where uh, hey, this is given the preponderance of all the data we have, this is kind of what we think the type of year it's going to be and the general trajectory of things. But at the end of the day, we have to trade the markets we have, and that's what the TA is telling us, right? So you're still fully allocated, like you said. How do you plan to navigate the rest of this year? Is it going to be more stay fully allocated until the TA tells you something different? Or, are there other times where you might say, hey, given this concern that's big enough, we're going to start pumping the brakes maybe a little early, or we're going to hit the gas a little bit more because we're getting more excited about these green shoots we're seeing elsewhere.
So probably, it's obviously hard to tell now, but if we're on the roller coaster ride that Lance and I think we're on, we're probably going to be rotating, moving from value to growth, from small cap to large cap to whichever factors and sectors are working, and kind of just rotating around, trying
So
if
leaning
the
into those
market,
correlations that you were showing us.
exactly, if the
Yeah.
market's going to end up flat and we can end up 4% because we were in the right things at the right time and out of the wrong things at the wrong time, you can beat the market. But it wouldn't surprise me if we go through periods where we drop our exposure, where we may only have 45% stocks despite, having a benchmark of 60%. Because on balance, I think the risks are probably more negative than positive. So, if our technical analysis starts jibing with some of the macro analysis, that may lead us to cut, not just rotate, but cut back. But, keep in mind that rotating is a form of risk, is a risk strategy. So, go back to 2000. If you had just been in smaller value stocks, you had a great few years, despite the markets getting crushed and tech being destroyed. You did just fine. So, maybe it turns out that all you need to do is be in larger value stocks and they'll perform well this year despite the broader market declining. Or maybe it's just consumer staples or energy or, whatever the sector or factor is that you can avoid risk without taking your exposure down. Or we just feel like everything's at risk and we'd rather just take our exposure down and rotate within that lesser exposure. Um, and, granted, if we see signs that this market's really getting to, looking more like a 20% or more decline, we can bring our exposure way down, way below, down below 30%, 20%. We'll exit. And we can also use bonds. They've been a much better hedge this year than they have been the last couple of years. And historically, they're a really good hedge for the stock market. So, if you look at our returns this year, we're up for the year. And that's because of bonds and because of large cap or rotation into large cap value 2 months ago, whenever that was. So, there's many ways to manage risk, and it's not just selling.
All right. Well, look, first off, kudos to you for being up for the year and a year that's been, such a unpleasant surprise relative to
I
the
need
past
to
two.
knock on wood there.
Yeah, I should. Yeah, exactly. Um, but certainly, relative to the two easy years of 2023, 2024, you just buy anything and hold on, you're doing great. So I do want to use this as a transition now to talk about bonds, but just real quick, I got to imagine there's a lot of folks watching for whom this year is a lot less fun, right? They're opening their statements, or they're maybe watching in real time their brokerage balances and saying, "Wow, I thought I was a genius. Maybe I'm not as smart as I thought I was."
Right.
So all I'd say is, if you're saying, "Look, I don't think I'm really the right person to be navigating my wealth through a volatile year like this," if you're feeling that way, then I highly recommend you work with a financial advisor, and one that's got a good framework for trading markets like this. And obviously, you can go talk to Michael and Lance and the team there at RIA if you want to. And if you're a DIY investor, then obviously you want to have the best instrumentation that you can have through this volatile year. And you were showing a lot of the charts earlier that came from your SimpleVisor service. And I just want to remind folks, SimpleVisor is a great way if you're a DIY investor to look over the shoulders of Lance and Michael and say, hey, what are these guys doing? Maybe I want to copy some of what they're up to. And even if you don't, there's just a ton of data there, like a lot of those correlation charts and other things you were showing us that you can use to inform your trading. So if you're a DIY investor and want to up your game, think about subscribing to SimpleVisor.
Thank you. Thank you. I mean, it's what, we use a lot of different things, paid services, free services, but SimpleVisor is one of our go-to guides. So it's not just something that we put out there to sell. It's something we use. And it's a great tool that works really well for us.
Yeah, well, I mean, as Lance said when he was walking us through it initially, it's the tool he wanted, right?
Right. Yeah.
Yeah, and so, anyways, I just want to make sure SimpleVisor doesn't get lost in the shuffle here. All right, so bonds. You and Lance for a lot of last year were taking some slings and arrows for your position on, but your stance on bonds, we'll say. Now, obviously, you run a 60/40 model, so you're going to have to be, materially in bonds running that. But Michael, and you've been very consistent whenever I brought you on to say, hey, we're not changing our thesis yet on bonds. And for much of the past several months, yields have been marching down. Inflation has been cooling, as you guys, I think have expected that to happen more than the average person who's been worried about sticky inflation. So where are we in the bonds market relative to your expectations, and how do you feel about them going forward?
So, like I kind of started, I think right now they're just stuck in this risk on, risk off trade. And that may dictate their movement for the next week or two. But at some point, the fundamentals will overtake. And if the economy is slowing, whether it's a recession or just a slowing economy, that should push yields lower. If inflation continues to fall, which we think it will, that too should lead bond yields lower. But we've talked a lot about the bond term premium, and what was driving that is fear of fiscal deficits and inflation. If Trump can really make some progress on the deficits, that should help alleviate that term premium. Um, so, everything I've told you that we've talked about the last few times we've been on still hold true. I think bond yields are still way too high. And it's funny, Trump and Bessent are constantly reminding us of that. They understand how important bond yields are to economic activity and to the fiscal deficit because that interest expense is massive. It's over $1
Right.
trillion in annual interest on the debt. So they know there's a lot of debt that's going to mature in the next year that has to be reborrowed, and they'd rather borrow it at much lower interest rates. So, at least now I feel like the president and the Treasury Secretary are on the bond bullish side, which didn't seem was the case with the last administration.
So, Michael, you mentioned earlier that you think that Trump still keeps a hawk eye on the stock market, even though he's not beating his chest about it the way that he used to. You probably heard the comment that I've heard pretty frequently recently, which is that while the S&P, the Trump put in Trump 1.0 administration was on the S&P, the Trump 2.0 put is on the 10-year.
Right.
Yeah. And do you think, it sounds like you think there's probably a fair amount of validation or a reason to believe that.
Seems like it. Seems like I don't think he follows it as closely as the stock market. But I certainly look, he's a man that made a fortune using leverage. He understands the value of interest rates and how it increases or reduces economic activity. So he certainly understands interest rates and why they matter so much. So yeah, I mean, I do think there is the bond put for this next 4 years, or at least, till they can get interest rates manageable.
Okay. So you said that you think bond yields are still way too high. For you, where are you expecting them to equilibrate to?
Depends. If we go into a recession, we could be back below 2%. if we just kind of simmer out and just have go back to or below what was, we are back to the growth rates that we had before the pandemic. We're kind of right in there. So if we kind of just have slower growth, maybe we're talking 2.5, sub 3%, somewhere in there.
Okay, so but sub three.
Three, sub three. Yeah, I mean, what are we? Tens are at 4.25, give or take
Yeah,
a little. So
that's
there's
still a
still a
material
decent,
amount. Yeah.
the term premium has erased a little bit, but there's still at least 0.5% there, if not more. And then just the effect of lower inflation and lower deficits and weaker economic activity.
Okay. All right. So, people who think about taking a longer duration bond position, they're largely doing that, expecting hoping for appreciation, right, on the bond price, buy yields going low. If you're basically saying, hey, it could go 3 to 2, like that's pretty substantial appreciation. That is a reason to consider taking on that risk.
Yeah, absolutely. You get paid the coupon 4.25% plus the price change, which if it's like a 10-year bond, that could be another 7, 8% on top of the coupon. It's
Okay.
not, 12, 13, 14% isn't bad for holding a risk-free treasury bond.
Okay. And I just want to note, I talk to and my day job is to talk to experts. I do 5 of these videos a week, at least. And this is still the area where I see the greatest amount of difference of smart people. So I'm very interested in seeing how this plays out over time because they're very smart people on both sides, but there's still a lot of people that are very concerned about structurally higher inflation and that the bond market is going to continue to demand higher yields and stuff. And you and Lance have given many times your argument for why you don't think that's going to be the case, at least in the near to moderate term. So I won't make you launch it into it here, but I just want to note this, on most topics, there's a plurality of folks, a plurality amongst the folks that I interview here. This one still is very kind of down the middle.
Right. Good. That's
Yeah,
two
that
views make a market.
two views make a market, exactly.
And it also, reading and hearing those opinions, whether you're interviewing them or just reading papers they put out or in the media, opinions that are opposite to what you think are really good to read because they either give you more conviction in yours or they make you question some of the inputs into your decision and you may, start changing your mind. It's okay to change your mind. That's, there is no one has a crystal ball. We're just trying to figure out what's coming next. And someone may have some really good points that say, you know what? Maybe I'm wrong. Maybe I need to rethink tariffs or I need to rethink structural growth and that maybe the right rate is 4.25. Maybe it's 6.25. Maybe I've gotten this all wrong. So read other opinions, listen to other opinions because they are extremely valuable.
All right. Well, look, as we start to wrap up here, you talked about risk on, risk off. Obviously, bonds are a big risk off asset during those periods. What's been interesting is that gold has been kind of rising through it all over the
Hmm.
past several months, and certainly in recent weeks, it's done great. And the week we're talking here, we'll close out with gold pretty much at a new all-time high. It futures markets hit $3,000 an ounce for the first time yesterday. I believe early today we saw the spot price briefly hit 3,000 an ounce as well. And gold has been chasing that for a long while. A lot of longtime gold holders who, if I had told a year ago gold would be at 3,000 an ounce, they wouldn't have believed me, but would have been, ecstatic to hear that. Um, so what is an all-time high gold price like this telling us?
It was a quote unquote risk on asset, right? It was rising with crypto and the high beta names. And you're right, it's diverged. It's kind of held its own while those guys have faltered. So, eh, and we have, it's a very confusing market right now. We're hearing about all these inflows of gold into New York from London. So there's some underlying currents that I got to be honest, I don't fully understand pushing gold up. But, you know, what's crypto? It's digital gold. That's what people call it. Digital gold. It's the gold replacement. It's another form of gold. I wonder how much of the flows are coming from the crypto market saying, you know what, I own all this crypto, maybe I should own some gold. Or crypto's too volatile for me. Look at gold. So they're chasing gold as the alternative currency. Uh,
I'm
gold
not hearing a
likes,
lot of echoes from the crypto community about that yet, but who knows?
yeah, but I'm sure some of them, the ones that aren't the believers that are just on it for the ride, have sold some of their crypto and trying to find a similar ride that may be a little less bumpy. Gold loves uncertainty, and we have uncertainty in spades right now. So that's part of it as well. It's hard to explain what's going on because there's so many cross currents right now. But when we go back and look at this 3 months, it will become more apparent why gold was doing better um, than things like crypto or high beta. And I think we'll be able to better diagnose it. But for now, there are just so many cross currents running through the market that have really very little to do with fundamentals that it's just hard to know why investors like gold, but not some of the other assets that have been traveling with gold. And you can easily pull out all the typical gold bullish arguments, and they're fine, they're good, but it's risen a lot in what looks to be that we're getting our fiscal house in somewhat control. The war in Russia, Ukraine looks closer to an end than it did a few months ago. The Israel Hamas battle has simmered down. Some of the arguments for gold are not as strong as they were, but the price keeps going up. So
Would your advice to folks that have really ridden the gold price up here, like good time to maybe take some of those gains off the table for
it
that
is
reason?
overbought. Well, it depends why I own gold. For me, it's an insurance policy. I don't, you know, I don't touch it. I just leave it and it sits there. And if it goes to 5,000, great. If it goes to 1,000, great. It's just like my insurance policy. I hope it's one I never have to cash in. But at some point I'll sell it. Uh, so for me, it's nice. But for if you're trading it, I'd say it is a little overbought. And if we are going to risk on where crypto and high beta kind of take control here, my guess is gold does underperform here.
Okay, takes a beat, takes a pause. Okay, well, folks, very quickly, if you didn't get on the gold train and are thinking, I probably should have some exposure to this asset class, or if you're still a relatively new investor in gold and want to better understand the different ways in which you can own it, the different form factors, whether it's bullion, whether it's bullion that you have, whether it's bullion that's stored remotely in your name, whether it's sort of paper gold through the ETFs, whether it's the mining shares. I have written and released, it took me a lot longer than I had wanted it to, but released Thoughtful Money's new guide to how to buy and store gold and silver. If you want to read that, you can read it for free. It's available right now. Just go to thoughtfulmoney.com/gold. And whether you read that or not, if you are actually looking to buy or store gold or silver, there's lots of options that I lay out there in that guide. But I have been looking for much of the past year for a precious metals dealer, similar just to the way that I refer folks here to financial advisors that have sort of passed Thoughtful Money's threshold of quality and capability, and like RIA is a great example of that for the financial advisors. I wanted to find a precious metals firm for that as well, because obviously I get hit. I'm getting bombarded these days, but pretty frequently get hit by people saying, "Hey, where's a good place to buy this stuff?" So if you didn't catch the interview that I did earlier this week with Andy Schechtman from Miles Franklin, that's his firm. Miles Franklin is the firm that Thoughtful Money has, through a long process, selected as its endorsed precious metals partner. And Andy has been in the business for 35 years. Has a fantastic track record and a fantastic, combination of both trust selection, price, good pricing, and customer service. And he has personally offered that he will give personalized attention to any thoughtful money viewers that want to engage him in his firm, even just to call him and ask him questions and whatnot. So if you want to talk to Andy or one of his lieutenants, just send an email to info@milesfranklin.com and they'll reach out directly and give you, as they said, the bespoke white glove treatment. All right, Michael. Well, look, I was going to ask you about your recent piece, tokenization, but I don't think we have enough time to really do that justice here. So I'll earmark that to talk about the next time you come on the program here. But just the 20-second version of that, it does seem like you think that could unlock some really interesting opportunities for investors going forward.
Yeah, I mean, it's really just a way to just further enhance our capital markets so that you can basically make anything tradable. You can securitize anything in a much easier fashion using the blockchain. But read the article. There's a lot of it's a very interesting read and thought-provoking.
Okay. And for folks that have heard you on the program before, Lance on the program before, who you have some issues with, some of the crypto offerings out in the market right now.
This isn't crypto.
This isn't
This
crypto.
is,
You're talking about the
I
underlying
mean, it's
blockchain
in the same
technology here.
family, but and I kind of lead the article that way. I start off, you're going to be surprised to hear this, but there's part of crypto that we like. Um, so it's basically like your bank. There's no cash in your bank. It's a bunch of ones and zeros. It's just digital money. Well, tokenization is just digitalizing assets, so to speak. So there is a real asset behind this digital token. So it's unlike crypto, like Bitcoin or these silly meme coins, which have nothing behind them. This is backed by an asset.
Yeah, yeah. I almost think about it like allocated gold in a gold storage solution
Exactly.
where there is an actual coin with your name on it that says this is Michael Lebowitz's. It's backed by something real. All right, great. Well, folks, if you want to read that, like I said, we can dive more deeply into that next time you're on, Michael. But folks, if you want to read it in advance, you can just go to realinvestmentadvice.com and read it on that. All right, so last question for you. And folks, we're not going to do a rant today just because I got to get ready to prepare for tomorrow's conference. What trades, if any, specific trades, if any, have you guys made over the past week?
Good question. Looks like the only trade we made this week in the equity portfolio, we added to Arista Networks ANET, we added 1%. That's one of those high-tech growth beta names that had been beaten up that we like a lot. We were waiting for it to come down. We bought 1%, came down more, so we doubled down on it. So now we own 2%. And we also added 1% of the Vanguard Mega Cap MGK in our sector model.
Okay.
Again, very similar themes. We think we're rotating, they're very slight rotations into growth. Again, nothing major, and our exposure has roughly stayed the same, if not declined slightly over the last month or two.
Okay. All right. Well, look, thanks for sharing that. Again, congratulations on performance to date this year. No guarantee about what your future performance this year will be, but as you said, we'll knock on wood and keep fingers crossed. All right. Well, look, Michael, it's great. Like I always say, that Lance guy should go on vacation a lot more often.
No, you don't want him on vacation because he was on vacation Monday through Thursday, and you saw what happened with the markets.
I know. I know. That is the curse of being in this business, right?
You may like interviewing me more, but you want him at his desk because the markets are in much better shape with him there.
Okay. So his correlation with the market is basically -1 in terms of his presence in the office.
Yes, yes.
Yeah. Okay. Or I guess his absence from the office is -1 correlated with the market.
I'll
All
add
right.
that to our simple visor.
Great.
That
That would be
analysis.
excellent. I'm sure. Yeah, exactly. The most important correlation, Lance's travel schedule. All right, folks. Well, look, if you've enjoyed having Michael on, which I'm sure you have, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Thanks again for stepping in for Lance, Michael, but you're welcome here anytime. I know you're enjoying some of the March Madness basketball this weekend, so have a great time there.
Thank you. Thank you. Looking forward to it.
All right. And everybody else, thanks so much for watching.